Hi, it's Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. It is Friday, February 27th, the last full working day in the month of February. We are just about to go on the road. Next week, we will be coming to you from New York City. On Thursday at noon, we have a special podcast with a particular focus on AI and what it means for the investment management industry. Our special guest there will be Jai Jacob. He is an asset manager, multi-asset allocator who has spent over 25 years focused on these issues and has always had an edge when it comes to AI. So we look forward to hosting him in person. We will also have our regularly scheduled podcast coming to you earlier that day. So in light of that, let's bring up the slides for a slightly shorter than usual podcast this week in expectation of a lot of content next week. I've called this week's podcast More Flurries, as it does seem that we are continuing to be in the continuous winter in the northeast of the United States, with a record blizzard there last week and ongoing cold temperatures. Weather has been more temperate in Europe for sure, although next week in New York, it does look like we'll be dipping into the snowy conditions again. There have also been a number of flurries on the geopolitical front, namely around tariffs, as well as flurries of anxiety around AI and what it means for job losses, as well as where some of the lines are drawn when it comes to national security. And interestingly, the recent discussion by Anthropic and its standoff with the Department of War in the US around the use of its devices, Claude, for mass surveillance, really underscores how even the developers of these highly intelligent agentic models have recognized that it is not yet sufficiently safe and fail-safe to be used in whether it's in autonomous weapon action or in surveillance. So very interesting developments and flurries of concern relating to AI there. As usual, we will cycle through our usual 5 topics of inflation, interest rates, equity markets, geopolitics, and other asset classes. And in terms of subtopics for this week, we will again return to the tariff tussles and look at what that may mean in terms of geopolitical certainty, as well as the trade situation more generally. We will reflect on the State of the Union delivered by President Trump this week and whether that suggests anything around the economic vibes. When returning to the area of AI, we have had a week where we have been immersed in fantasy in terms of a Citrini 5,000-word essay setting out a particularly dystopian view of the AI future. And we will look to some of the counter arguments that have developed around that, as well as some of the other news flow around AI. Turning to crypto, we look at whether a floor has in fact been reached there. And finally, doing some navel gazing with respect to our own industry, that of private wealth, which has been disrupted by AI advances just in the past few weeks, but continues to be strongly in the focus for private equity firms. And in our analysis of private equity and alternative products, we will look at what is turning into a bit of a bleak winter for private credit strategies, and we'll try to parse what that means on the investment side. So starting out, clearly the news of the week was the US Supreme Court striking down the recent tariff regime, suggesting that they were unconstitutional, not justified on the basis of emergency legislation, and that Congress should have stepped in essentially to validate and verify those tariffs. We can see that whereas that might have been resulting in simply the tariffs being removed and ultimately rebates being paid, President Trump is taking a more combative approach to this and suggesting that there will be more tariffs across the board. We can see that this is already stoking US-China tensions. President Trump is just about to visit Beijing. And we know that there has been some fairly, I'd say, hardline rhetoric from China in respect to their potential to retaliate if US tariffs are put in place. And we also know that now that the floodgates have been opened around other potential legal challenges around tariffs. So this has added to a stew of a fairly uncertain and volatile equity market condition over the course of this week. It seems that the appetite for more uncertainty when it comes to global trade is not particularly strong. The initial Supreme Court judgment could have resulted in a strong boost to the economy, as it would have added certainty around tariffs being removed and also offered the promise of rebates and checks being injected into companies who have already paid those tariffs. And it should have removed some of the inflationary impact which the tariffs were likely to have in a delayed form. Now, this current tariff tussle suggests that we're not going to get that likely uncertainty, although the rebates at least could be promised, although they might be slightly more complicated in terms of how they come. Moving to the equity markets. So before we discuss some of the flurries and the uncertainty around AI that has been circulating and cascading, we can see that despite NVIDIA showing really staggering numbers when it comes to revenue and really exceeding their own estimate, we can see that this has been really blowing through estimates in terms of a 94% increase that we've seen over the course of the last quarter. Of course, for a backward-looking indicator, but an indication that most of the expenditure that we've discussed in previous podcasts around the large CapEx spend has been flowing through into NVIDIA. What we do know is that there is concern around their exposure to the hyperscalers. And I'd say a degree of skepticism, a strong degree of skepticism that is receiving NVIDIA's earnings. And that has not been the boon that equity analysts were expecting, given NVIDIA had just announced. Staying on the area of AI, we have had a flurry of news flow over the course of this week, starting with that Citrini article that I mentioned, which laid out a fairly dystopian future when it came to AI. There was a suggestion that not only would AI disrupt software providers, but equally that traditional finance providers will be disrupted as the shift would move away from credit card infrastructure into stablecoin infrastructure, and that essentially many shortcuts and many intermediaries will be removed from the picture. This would also have translated into fairly sizable unemployment numbers and just that rupture. I use the word rupture that Mark Carney had used at his Davos speech, because that is definitely, I think, apt to describe what the Citrini research has suggested would cascade through established commerce as a result of AI. This was one potential future. We know that there is a binary, essentially, that there is another potential outcome, and that another middling outcome is for pretty much more of the same, some impact of AI, some efficiencies, but equally other shifts to managing superintelligence, which is this abundant intelligence that AI is likely to bring. So a lot of concern and sell-offs in the likes of Visa, MasterCard over the course of this week. Other news relating to AI is more recent. We've just seen in the last 24 hours an announcement that there will be a cut of 40% of Block's workforce. That is the former Square, a fintech company set up by Jack Dorsey. And he was fairly forthright in his discussion of why these cuts were being made, that essentially they had the ability now, thanks to AI agents, to be a leaner company with more focused employees, more productive, thanks to them being able to harness this. His decision had been to take an initial large cut instead of taking a series of small, painful cuts, with a generous severance package provided. But this was 4,000 employees and 40% of their workforce. This again sent a chill through the Twitter sphere and through the social media sphere as a harbinger of things to come. It was suggested that Jack Dorsey, as a visionary, was perhaps taking the harsh medicine initially, and that as when Jack Dorsey, so would other entrepreneurs and CEOs. We do know that Block stock was rewarded significantly for this indication, but we've also seen other stocks being rewarded for their suggestion that they would bring into place cost cutting. So this is nothing new in particular. I think it is also worth pointing out that when Elon Musk took over Twitter, which was another company run by Jack Dorsey, he also made sizable headcount cuts to the tune of 80%. So whether we think Jack Dorsey is a visionary or whether his companies are just very well staffed, this remains to be seen. But I think this was the chilling piece of news that we really did not need in AI over the course of this week. Second piece of news we've seen is Anthropic taking a strong stance with the Department of War in terms of Claude not allowing Claude to be used, putting guardrails in place for unmanned weaponry as well as for citizen surveillance. Claude has always, Anthropic has always drawn the lines in terms of having a constitution and really thinking hard about the ethical implications of its agent. I'd say that this, again, is an indication of more friction that we are likely to see when one AI company takes a stand like this against the federal government. Perhaps it gives more ammunition for other companies to draw their own lines in terms of ethical use of AI. But what was most chilling, I had thought, from that particular statement was a recognition by Anthropic that the model was not to be trusted, essentially, with unmanned weaponry, and that this was a reflection of its own limitations. We know in the past that there have been concerns around the multibook development, for example, around the potential for AI not to be trusted without guardrails. And this, again, coming from the call coming from inside the house, typically, is another sign of that concern. So quite a bit of news flow relating to AI. It is generally reflected in this rotation we've talked about for many weeks, rotation away from the hyperscalers, away from large tech, into other sectors, still including the picks and shovels. But I would say that these latest pieces of somewhat dramatic news, each one is really feeding into just a moderating and a modulating of sentiment when it comes to big tech. Moving across the Atlantic now, I think it's interesting to compare different equity markets and how they are behaving. This is coming from the UK perspective. Two large buybacks announced just over the course of this week. We've seen that the buybacks occurring the London Stock Exchange as well as Rolls-Royce, both seen heralding good news for shareholders, a way to essentially reward shareholders, and in one short-term measure to be a boost for owning stocks in these regions, that this has been a way to ultimately drive the share price and drive an interest in investing in the UK. This has been a practice that has long been undertaken in the US, buybacks in order to reward shareholders and award the culture of equity holding. Overall, however, though, if buybacks take place, this is money that is not used for capex. It ultimately shrinks the pool of public companies and does lead to a less attractive market overall for equity holders in the long term. Just to compare, if we look at the chart on the bottom, the hyperscaler spending and debt issuance, we can see that there has been tremendous capex indicated by the turquoise line in 2026. So if we compare where the capex is happening, we look to the medium and long term, the capex is continuing to happen in the US on that side of the Atlantic. And that has been really an indication of just this cleavage that we're seeing in terms of the outcome and the prospects for technology in the US versus everywhere else in developed economies. The exception there would be China and certain other Asian economies. Moving to private credit now, there's been another flurry of headlines relating to this, and this crops up every few weeks. It seems investors turn away from their AI anxiety, or they add to their AI anxiety by wondering about the impact on private credit of some of the, say, the software fallout. What we have seen has been, particularly, this is not new, to see a closed fund, in this case Blue Owl, that has been forced to either shut its fund to redemption or to take a markdown in terms of its where it's trading. What we know is that there are certain markdowns in the BDC arena that are natural when we see interest rates falling, and that BDC being having floating rate credit does tend to be related to interest rates. So as interest rates fall, which they are generally around the world currently, there will be a lower dividend accruing to BDCs. We've seen cuts in the dividend occur not only in Blue Owl, but also in KKR BDCs. And this has been a fairly, I'd say, common pattern across some of these private credit structures. We are also seeing, though, that just the share price of these credit managers, whether it's Blue Owl, Ares, APO, have been falling quite significantly over the course of this year. We have noted this in the past in terms of just the potential exposure of some of these strategies to negative sentiment, and equally a question mark regarding the fees and the sustainability of the fees in these areas. I'd say what's occurring right now is we're still remember the cockroach talk that Jamie Dimon would have discussed, and that Jamie Dimon, this is now, he's even referring to pattern recognition within private credit, that he speaks, of course, about his peers, not about JP Morgan itself or about other established players making mistakes, being slipshod about due diligence, and not taking into account the risks of defaults that are in place across these sectors, as well as just the rush to do deals, which has led to many factors being overlooked. And we saw that in some of the fraud cases of recent months. But what we can see here is that if there is some pattern recognition, it's starting to look to some onlookers like the run up to 07-08, when private credit did have a lot of concentration. We are taking a cautious view of this, because we would say that certainly there is a reason for many of these things to decline. One notable activity that we're seeing in the case of closed funds is that there have been so-called vultures or value investors picking over these closed funds that exposed to private credit and seeking to really mop them up at the current discount to NAV that they're trading at. This suggests that these very experienced vulture investors think that there is very much money good in these strategies and that this is a technical aberration. So if that's the case, it would suggest that actually the credit worthiness of much of this private credit is a lot more significant than we would otherwise give it credit for. The interesting observation about this fallout in private credit is that it is very awkward timing. And why is that? Because this coincides exactly with a ramp up in the use of private credit and other alternative vehicles within 401k plans and within retirement plans, as this democratization of alternative assets has gone mainstream. We know that there are two phenomena at work here. One is the increased use of alternative assets within retirement plans. We've always been extremely cautious about wholesale adoption of illiquid strategies if there is not the proper communication that there needs to be a match of assets and liabilities within, and liquidity and liabilities within any portfolio, no matter the size. So that this is one thing. But it's also the case that this also coincides with private equity firms having had a particularly torrid time when it comes to distributions. And we know that there, from the chart we showed last week, there is both a lot of dry powder on the sidelines as well as a real sluggishness when it comes to distributions. So that that is then translated into a challenge with raising new funds. So having a lot of existing dry powder by private equity firms, but having a challenge in raising new funds, that can be a motivating factor that is challenging for the team there, as it may, not only would it stymie new generation of talent development, but it can also lead to just challenges within an existing team if they're not seeing the incentives play out because they haven't been able to invest the funds raised. It also does not bode well for LP-GP relations. However, we know that they're finding it harder to raise money, as this chart shows, and that is going to be just some pain within the private equity landscape. This also coincides, however, with what private equity is doing in terms of its move into the wealth sector. And this is perhaps a time for some navel gazing. We know that there has been massive buyout activity in the wealth sector. They have to date snapped up almost 1,000 US wealth and retirement firms. We see roll-ups happening at a really staggering rate. And why is this? Because this is an interest in the swelling retirement sector. We've seen that by this quote, America's retirement assets are totaling almost 46 trillion, of which 14 trillion are in 401ks. We know that these will be very much in target for the private equity firms seeking to gain access to the sector. This is also the pot of money that private equity and private credit and other alternative providers would like to see being used in their own portfolios. So they'd like to see more alternatives being used there. So this is essentially seen as a gold mine, 46 trillion, very significant between defined benefit, IRAs, and defined contribution plans. Definitely something to watch when it comes to where the money is moving. Finally, when we look at what's been going on in Bitcoin, Bitcoin used to be the bellwether for sentiment when it came to trade disputes, as when we saw an upping of the rhetoric between the US and China, it was clear that Bitcoin was going to be the first asset to fall. And this was perhaps a signal of where risk off was on the table. We also had, on the other hand, gold showing strong increases at the end of last year, as it was a concern not only around the uncertainty in geopolitics, but also around fiat currency, concern around debasement, and a concern around some of the fiscal and budget situations there. An interesting observation is that Bitcoin ETF assets and the Bitcoin price itself, they seem to have stabilized recently. Whether that's an indication of a floor, an indication of just more depth in this market and breadth, we don't know yet, but it is interesting that there has not been a continuing sell-off within Bitcoin, despite some of the continuing uncertainty within geopolitics. So that is our discussion for this week. As I mentioned, a lot of flurries of whether it's fictitious or fact-based situations when it comes to AI, and a bit of a chill in the air, both physically and metaphorically, as we look forward. Thank you very much for listening. We look forward to having you tune in next week to our live event in New York, as well as to our regular scheduled programming. Have a good weekend, everyone.